All right, here we go. Get ready. We are going to get our first look at fourth quarter GDP in just a few seconds. We want to introduce our panel this morning. Wendy Edelberg from the Brookings Institution is with us. Also, the American Enterprises Institute's Michael Strain. Nancy Davis from Quadratic Capital Management is here, along with PIMCO's Tiffany Wilding. Our own Steve Liesman and Rick Santelli are here, and Barry Sternlicht is with us as well to see these numbers and react. Right now, Dow Futures up by about 63. It is time for the fourth quarter number. Rick, take it away.
All right, well, let's start out with what's going on with initial jobless claims for the week ending January 23rd, 186,000. 186,000. That is a new cycle low. That's going to take us back to April of last year, 22. And if we look at continuing claims, 1.675 million, 1.675 million. GDP, 2.9%, 2.9%. Obviously, that's a good quarter, maybe the last positive quarter that we get with respect to growth in the economy. And as we start to look at some of the other numbers populating here, I see that durable goods is coming in. Durable goods coming in at up 5.6%, up 5.6%. That is a very strong number. Now I'm getting the rest of the data with regard to GDP on pricing. The price index is 2.1%, 2.1%, and that is a very good number. If you're looking for inflation to come down, that comes down from the 2.3 level. And the last time we were at a 2.1 level, you have to go back to the second quarter of 2020 when it was minus 1.3. And if we look at what the quarter-over-quarter personal consumption expenditure core is, it is under 4%. Many predicted that. It's 3.9%, 3.9%. The last time we had a number in that camp was the first quarter of 21 when it was 3.2. And if we look at the final numbers on the trade balance, minus 90.3 billion. That's bigger than anticipated. Wholesale inventories up 1/10, much smaller. That's a decent preliminary. Retail inventories up 0.5, double expectations. And we're getting some revisions. Last month's 190,000 on initial jobless claims. Subtle change to 192. And if we look at the ex-transportation, remember, durables up 5.6% is extremely strong. As a matter of fact, that is the best number going all the way back to the summer of 2020. And if we look at all the internals there, you can tell it was transportation figured in prominently, because once you take transportation out, 5.6 nosedives to minus 1/10 of 1%. If we look at capital orders, non-defense ex-aircraft, a proxy for capital spending, it's down 2/10. That has been a rather bumpy ride, but we've had some solid months. Down 2/10 is not one of them. You look at shipments, also a very depressed number, down 0.4 of 1%. Both of those numbers were predicted. Both of those numbers were built in. Both of those numbers are preliminaries, and they may change. So just a quick recap. Both the pricing issues on the GDP came in less than expected. If you look at interest rates, they are moving up. They're moving up. Now, not huge. We're up about 2 or 3 basis points in a 10. The equity markets have dropped a bit, pre-opening Dow futures. I think what they're concentrating on most is probably initial claims and continuing claims being on the downside. I find it hard to believe the market's going to be too upset with regard to the GDP numbers. However, the final comment I will make is when you look at the price index, it is definitely well below last month's 4.4 at 3.5, but many were expecting an even lower number. Becky and the gang, back to you.
All right, Rick, stay with us. We want to bring in more of our panel for some instant reaction on this. And Steve, I'll go to you first. That was a lot to digest. Which of those numbers are the most important?
You know, I like the durables number. I think we're living in two worlds. We're living in the world of the present, which has pretty strong economic growth right now, which has that strong GDP number, declining inflation. I didn't look at the consumer numbers inside the inflation numbers. We're very interested in what happens tomorrow by figuring out what happened in December. And we're living in the future, which is a future of a really lackluster, lame forecast of a stalling economy. So you look at this number and you say, well, what happens in the first quarter according to the forecast? the economy stops on a dime. And it's hard to see in these numbers the economy stopping on a dime. From a Federal Reserve standpoint, I think they're going to look at the top line number, which is 2.9, and they're going to say, I need an economy that needs to be running below potential. And that potential is maybe 1.8, maybe it's possibly lower. So it's an economy that has not created the slack that is ultimately needed, that they believe, to bring down inflation. And then you add to that these jobless claims numbers, which just frankly won't quit. I mean, you keep thinking, you keep hearing these marquee announcements, Becky, of all these layoffs, and I yet to see them either in the continuing claims numbers or in the weekly claims numbers.
I don't know if part of that is because a lot of these people get severance. It may take a while for that to kind of work its way into it. But Barry, the Fed looks at these sort of numbers, looks at this data, and there's nothing in this data that's going to tell them to slow down.
I'm curious about that transportation negative without the transportation that was mentioned, durable goods, because
is that right?
Autos or Boeing? Is it some jet orders?
Steve, you have any idea into that? I mean, to me, the auto industry's been so strong. I don't know if that's a big part of it, but is Barry right? Is there something else that's happening with deliveries?
Autos were down. Okay. Autos were down 0.4, and I'm looking here. Give me 1 second. Hold on. Sorry, I'm looking at the wrong numbers. Shipments and new orders. I will give you the Boeing numbers, which were lousy last month, were up. Write this down. This is not a mistake. I want to double check. It's such a huge number. Yeah, it's 115.5%. Wait, am I right about that? I just can't believe it. I just actually can't believe it. Rick, can you confirm that?
Yeah.
Yeah, I've got 115.5, and I have autos.
I can't confirm it, but I can confirm the fact that when you strip out autos, we go from 5.6 of transportation to down 110. So that fits. That fits. I can't see the nitty gritty there, but that certainly seems to make sense, Steve.
If it's that, if it's
I've got autos
it's so
up
big.
Though, Rick.
These airplane orders, they're so big. Again, the backdrop is the consumer. Look at the consumer. He doesn't have that money. There's two numbers in play here. There's the excess savings you keep hearing about, but I think that's concentrated in the top 5-10% of the country. I think the average consumer is struggling again.
Bank of America, if you talk to Brian Moynihan, he will tell you that they still have more money in their accounts, even the lower income individuals, than they did pre-COVID. But I've also heard that money could run out around June.
JP Morgan says it's going to run out, so I'm kind of going with that view because they see the spending patterns. We could have a slow, but maybe it's third quarter, fourth quarter. We're going to go negative.
Do we feel like we have enough input? How many people? What was the box that we had? I didn't notice.
I think there are 10 of us. No, it was 7 plus the 3 of us. I think it's 10.
Do you think 10 would help?
11 of us all collectively.
Do you think 10 would help?
Oh my goodness gracious!
Yeah, there's 10 of us.
I just think that
we filled it out finally.
I just think 10.
If we can play the Brady Bunch music.
How do you do it with 9? It's just. I mean, that's 10% more info.
I don't know. Hi, Becky.
Hi, everyone. Let's get some of our other guest thoughts on this, too. Wendy, why don't we start with you? Your take on what we see here, what the reaction is going to be. These numbers are good. The Dow's gone round trip. It went down and came right back basically to where we started before all these numbers came in. But there are some numbers that are significantly off from what had been anticipated.
So what we can't see in this quarterly number is the monthly pattern, which we'll learn more about tomorrow. And we will probably see that consumer spending slowed over the end of the year. And a slowdown in the economy has been in train for a long time now, with an expected payback from very strong consumer spending on goods, the waning effects of fiscal support, the effects of monetary policy. But to be clear, the slowdown that I expect we will see, and that we are already seeing in the monthly numbers, the slowdown that I expect that we'll see in the first quarter is a good thing. It'll show that the economy is starting to rebalance, get on a more sustainable path, and help to ease the pressure on inflation. So a lot of that is masked in this quarterly number, which is really about, at this point, ancient history.
Yeah, and that's the one thing we can say. All of these are kind of backward-looking numbers, Michael, and almost the better these numbers are, the more potentially it can pull from the current quarter.
Yeah, I think that's right. I mean, look, we know about December. We know that holiday sales were very weak in December. The retail sales number for December showed a decline of 1.1%. We know that industrial production was down in December, that industrial production fell by 0.7%. We know that there are problems in the housing market. Why are we seeing this slowdown in December? inflation, higher interest rates, people's inflation-adjusted incomes are dropping, and then people are facing higher borrowing costs. The quarterly number obviously looks at what happened over the entire quarter, which I think isn't the right thing to focus on in an economy that's dealing with interest rates that are rising this rapidly and with inflation dynamics that are as fast-moving as the inflation we're seeing. I think the key thing for the Fed is what Steve said earlier. We're still growing above potential. And the Fed wants to push the economic growth rate below the economy's underlying potential while keeping it positive. That didn't happen in the fourth quarter of the year. And the expectation that the Fed's going to stop around 5%, I think, looks more misplaced this morning than it did yesterday.
All right, Tiffany, one more economist perspective on this. The number that you think is the most important, that you take the most away?
Yeah, I mean, I actually was struck by the consumption number. I think you said 2.1. I think that was below consensus, and that suggests to me that underlying the surface here, the details of this GDP report were actually maybe a little bit weaker. So that could suggest final domestic demand, which I think is the key number for the fourth quarter, is 1% or even a little bit below. It looks like inventories maybe have surprised on the upside. So that's actually not very good news for the forward-looking growth trajectory. And I completely agree here that the monetary policy tightening that we've gotten to date, hasn't really fully been reflected in the real economy, and that's kind of yet to come. And there's a lot of uncertainty over the extent to which we're going to get, just weakness or actual contraction and recession next year. So if I'm the Fed, I don't think this number really changes my perspective. The other thing that I would just highlight is on the inflation numbers. To your point about how the quarterly masks, if you look at just the 3-month over 3-month, we're at 3%. The Fed's SEP projection for core PCE was 3.5, so that could come down. I mean, there's some downside risk there. Inflation news is good.
That's great. All right. If it doesn't change the Fed's perspective, Nancy, does it change investors' perspectives? You look at all of this. Again, the Dow's now actually indicated a little higher than it was before things started. We're up about 80 points. The yield on the 10-year did come back above 3.5% on these numbers. What do you do as an investor?
Well, all markets are forward-looking, including bond markets and inflation markets. So the cooling of inflation has been priced in for a while. The market's been very confident that the Fed quickly hiking rates, although they were probably late, is going to cool future inflation expectations. So I'd say that today's data was totally in line with where prices had already moved, even before today's data. And to your point, Becky, a lot of this data is backward-looking. So I think that presents an opportunity for investors to say, look, the market is pricing a 2% symmetric inflation going forward. You can see that in the 5-year, in the break-even curve, really across the board, it's right around 2%. I think that presents an opportunity for investors to say, look, fingers crossed, we hope the Fed's got this, but in case they don't, it's a good time to be adding inflation-protected bonds to a portfolio and other inflation strategies because it's all priced symmetrically around 2% right now.
Let me just ask you, Nancy, what you've seen in earnings, if anything, that changes your mind, too.
Well, definitely the consensus with Wall Street is that we're going to be either in a recession or earnings recession. So I'd say the surprise would really be if we did get, not as bad of a scenario as people are expecting. I think there is definitely a lot of FOMO in equity markets. Last year consensus in June, I had the pleasure of being on CNBC and said, like, I don't see anything that terrible. I don't know why everybody's freaking out in the equity market, and it did rally back. That was actually the low of 2022. So I think investors have to just expect the unexpected and really have a diversified portfolio and look for things in their portfolio that can help diversify when equities do sell off, because it's really, there are a lot of factors that impact companies, whether it's the labor market or still supply side disruptions that the Fed hiking policy rates isn't really going to touch. That's just hitting the demand side of the equation. So I think it's time to be prepared for any outcome, because we have had one of the highest and fastest tightening cycles in the history of our lifetimes. And also with the Fed unwinding their balance sheet with quantitative tightening, that's new territory. We haven't had that before.
Steve, is there anything in any of these numbers you think that changes the Fed's mind for next week? Is there Or were they already going into this meeting thinking they were going to lighten up a little bit?
No, I think they were going to this meeting thinking they were going to lighten up because of what was said earlier. They want to see the effects of what they've done and the lagged effects, and they want to step down. They do acknowledge that there has been, first, better inflation data, and second, somewhat worse off manufacturing data, as Michael Strain correctly pointed out. I will say that this notion that was just brought up that consumer spending was weak, I think, is worth noting. And I can't. Probably the third time this morning, I'm pointing you to that data tomorrow where we'll get that December data and see just how weak the consumer was going in. And by the way, it's the first time in quite a while that we've had contributions to GDP from inventory and from trade. What's been happening are these wild gyrations in the GDP numbers from you have the ports backed up, and all of a sudden they get opened up, and you get this influx of goods. They get stocked on the shelves, and then you have nothing coming in. And it's a little, this is the first time we've had positive contributions from both. It's worth watching. And I think the trajectory is softer, but you got to take that with a grain of salt because the expectation for this quarter had been for a much softer quarter. And here we have 2.9%, decent final domestic sales. And so you have to say, okay, this economy is supposed to weaken quite a bit, but will it really?
Got it. I want to thank our panel, Steve, Rick, Tiffany, Nancy, Michael, and Wendy. Good to see all of you this morning. Our guest this morning, Barry Sternlicht, has been with us for the last hour, 15 minutes or so. Hey, Barry, I want to change gears. I think you saw earlier that Chevron announced it's going to be increasing its buyback to $75 billion. That's 3 times the old buyback limit that they had from 2019. They're also raising their dividend by 9 cents. There is now comment from the White House on this, as you probably anticipated, probably expected. The White House comment is for a company that claimed not too long ago that it was working hard to increase oil production, handing out $75 billion to executives and wealthy shareholders sure is an odd way to show it. We continue to call on oil companies to use their record profits to increase supply and reduce costs for the American people. Probably not too different than what you anticipated, but what is this going to mean just in terms of what companies?
Handing it out to wealthy shareholders, to the people that are funding the operations.
I don't know why politics